Every time an economy crashes, we're told the same story. It hurts everyone. We're all in this together. Recessions are painful, but necessary. But here's the uncomfortable mystery. If crashes hurt everyone, why do the same people keep getting richer every time they happen? Why do fortunes grow during depressions? Why do billionaires multiply during recessions? Why does wealth concentrate most when the economy is supposedly failing? This isn't a coincidence. It's a pattern. And once you see it, economic crashes stop looking like accidents, start looking like opportunities. Economic collapses didn't start in the modern era. In the late 1800s, financial panics wiped out small banks while powerful financiers quietly absorbed them. In 1929, the stock market crash destroyed ordinary investors, but allowed well-capitalized elites to buy assets at historic discounts. Even then, insiders understood a brutal truth. Crises don't destroy wealth, they transfer it. But the system that makes this possible didn't fully mature until the 20th century. After the Great Depression, governments promised to prevent future collapses. Regulations were introduced. Central banks gained power. The goal was stability, but stability came with a cost. Money creation became centralized. Credit became the fuel of growth. Debt became the backbone of the economy. This planted the seed for modern crashes, because when growth depends on debt, downturns are inevitable. The question was no longer if economies would crash, but who would be positioned when they did. As financial systems grew more complex, a divide formed. On one side, wage earners, savers, small businesses. On the other, institutions with access to cheap credit, insider information, and political influence. When times are good, this divide is hidden. But during crises, it becomes obvious. The wealthy don't panic when markets fall. They prepare. They hold liquid assets. They hedge risks. They borrow at low rates. Crashes create fear. Fear forces selling. And selling creates bargains. Every crash follows a familiar sequence. A bubble forms, often fueled by easy money. Speculation rises. Warnings are ignored, then something breaks. Markets collapse. Credit freezes. Unemployment surges. This is the moment most people experience loss. Retirement accounts shrink, jobs disappear, homes are foreclosed. But this is also the moment opportunity appears for those who can afford it. Here's where the pattern becomes impossible to ignore. When crises hit, governments intervene. But they don't rescue everyone equally. Banks receive bailouts. Corporations get emergency funding. Asset prices are stabilized. Meanwhile, individuals are told to tighten belts. After the 2008 financial crisis, millions lost homes, unemployment soared, household wealth collapsed. Yet within a few years, stock markets reached new highs. Executive bonuses returned, corporate profits surged. Wealth didn't disappear, it moved. From the bottom to the top. After every crash, reforms are promised. New regulations, stronger oversight, fair systems, but the core incentives remain untouched. Central banks still inject liquidity during crises, benefiting asset holders first. Governments still socialize losses and privatize gains. Markets still reward those who can wait while others are forced to sell. Crashes don't break the system, they test it. And the system consistently protects those at the top. Look at recent history. During the 2020 global crisis, small businesses collapsed, workers lost income, debt exploded at the same time. Billionaire wealth surged, stock markets recovered rapidly. Asset prices hit records. The richest didn't just survive, they expanded. This isn't because they work harder or predict better. It's because the system amplifies advantages during collapse. Crashes compress time. They accelerate inequality. Here's the uncomfortable reality. Economic crashes are not purely failures. They are redistribution events. Those without liquidity sell. Those with capital buy. Fear becomes a weapon. Patience becomes power. The system doesn't punish risk-taking. It punishes lack of access. 3 key takeaways. First, economic crashes don't destroy wealth. They transfer it. Losses are concentrated at the bottom. Gains accumulate at the top. Second, the wealthy profit not because they cause crashes, but because they're positioned for them. Access matters more than intelligence. Third, bailouts and stimulus don't flow equally. They protect assets first, people second. The most dangerous myth is that crashes hurt everyone equally. They don't. As long as economic systems reward ownership over labor, every crisis will widen the gap. The question isn't whether another crash will happen, it's who will be ready when it does. So ask yourself, comment below. In the next economic collapse, will you be forced to sell or positioned to buy? If this changed how you see recessions, subscribe for more deep dives into money, power, and the hidden mechanics of financial systems.